Okay, picture this, it's mid-2025. You're an investor, maybe you put money into a UK equity fund back in 2022 or 2023. You check your returns, and you wonder, why is performance lagging? Why are foreign investors edging away? And what role did Brexit, global inflation, supply chains, AI, and geopolitics all play? Welcome back to the channel. Today we're digging into exactly that, how Brexit and global trends impact UK investments in 2025. We're going deep, not gimmicks, but real data, real strategy, and yes, a few names and recommendations along the way. If you want to invest in the UK or just understand where risk lies, this video is for you. If you haven't already, hit that subscribe button, seriously, it helps a lot. Drop a comment with your UK exposure, whether in UK stocks, funds, or via multinational firms that operate in the UK. I read them all. Let's jump in. Before we can assess 2025, we need to understand where Brexit left the UK, structurally. Because you can't judge performance in a vacuum, the past 6, 7, 8 years have made lasting changes. A quick recap and where things stand. The Brexit referendum was in 2016, actual departure in early 2020. But effects have cascaded over time: weaker trade intensity, regulatory divergence, friction at borders, loss of certain EU rights, visa and labour mobility constraints. According to the Office for Budget Responsibility, OBR, Brexit is assumed to have reduced trade intensity by 15% in their baseline models. Even in 2025, we're still feeling the lag. The UK's exports of goods to the EU in real terms remain about 16% below pre-2019 levels. Productivity, a perennial British weakness, is further held back. Some modelling suggests non-tariff trade barriers directly reduce long-term business investment 1.2% lower than without them. So, the baseline in 2025 is one where UK growth is structurally lower than it might have been. Exports are handicapped, especially goods. And trade with the EU is more costly and friction-filled. Structural shifts still playing out. Export profile shifted, UK goods exports have taken a hit, but service exports have become relatively more important. In fact, services now make up a greater share of UK exports to the EU than before Brexit. Non-tariff trade costs matter more, even though there is a trade agreement, the UK-EU Trade and Cooperation Agreement. There are still customs checks, regulatory divergences, rules of origin, paperwork. Those invisible taxes bite business margins. Investment drag, business investment in the UK has been weaker than expected in the post-referendum years, and some of the drag is attributed to regulatory uncertainty and weaker incentives. VC innovation flows reoriented. Studies show that UK VC hubs cut cross-EU investment early, and EU VC hubs later pulled back investments toward the UK after enforcement. Talent and migration constraints, loss of free movement with the EU means more friction in hiring EU nationals. This hits sectors like tech, finance, research. I won't dive deep here, but it's a known ongoing headwind. At this point, we should see Brexit not as a one-time shock, but as a long tail. Many of those effects are baked in and will interplay with global trends. Now, Brexit is part of the story, but the global environment is equally powerful. Let's go through the major global headwinds and tailwinds that in 2025 are shaping UK investment outcomes. 1. Inflation, interest rates, and monetary policy divergence. Across the developed world, inflation has been sticky. Central banks, Bank of England, ECB, Fed, are walking a tightrope. The UK has had to contend with inflationary pressures from supply chain constraints, energy prices, and imported inflation, especially as sterling fluctuates. One key risk: if the Bank of England raises rates, or keeps them high, while growth is subdued, that compresses valuations in equities and stresses credit markets. At the same time, global policy, e.g. the US Fed, debt burdens, yield spreads, all spill into UK yields and bond markets. 2. Supply chain reconfiguration and deglobalization. The global trend is shifting from hyperglobalization to more regional supply chains, friendshoring, nearshoring. The UK is trying to lean into this, but frictions from Brexit make it tougher to integrate seamlessly with European supply chains. Disruptions from climate events, geo-tensions, and resilience mandates, onshoring, magnify cost pressures for firms. This can make imports more expensive, squeeze margins, or force restructuring. For multinational firms operating in the UK, supply reconfiguration is a real cost center. 3. Tech AI digital transformation. AI, machine learning, digital infrastructure investments are surging globally, and the UK is positioning itself as a major AI hub. The question is, will UK tech firms, or multinational tech firms in the UK, outperform versus European or US peers? That depends on talent, regulation, data access, and capital flows. Investors will naturally chase the AI thematic, and UK's success or failure in that race will influence its attractiveness. For energy or climate, ESG transition. The transition to low-carbon energy assets, green infrastructure, and ESG mandates is a major capital flow driver. For UK investments, sectors like wind, nuclear, grid, hydrogen, carbon capture may become magnet sectors, but they also require policy consistency, subsidies, and regulatory stability. Also, existing industries may face transition risks, e.g. fossil fuel exposures, carbon pricing, stranded assets. 5. Trade wars, tariffs and protectionism. The global environment in 2025 is more volatile with rising protectionism. US tariff policies, retaliations, geopolitical friction all ripple globally. The UK must navigate these external pressures. Trade deals, e.g. UK-India trade agreement signed July 2025, negotiations with GCC states, etc. For external investors, trade policy risk affects how you price UK exposure in supply chain, exports, and financial plays. 6. Currency and capital flows. Sterling volatility matters. If the pound weakens, it boosts export competitiveness but erodes returns for foreign investors. Capital flight risk. If investors see the UK as less stable, funds may allocate away. In fact, reports suggest the UK is seeing exodus of high net worth individuals, millionaire outflows, partly due to taxation perceptions and uncertainty. Also, equity fund outflows from UK equities have been cumulatively large across the years. Think of the UK economy as a set of pipelines, each channel transmits shocks differently. The way inflation, interest rates, or Brexit trade frictions affect you depends on what kind of asset you hold. Let's go one by one. 1. UK equities. Let's start with the stock market, because that's where most of us invest first, whether through ETFs like the FTSE All-Share, or through international funds that include UK exposure. Performance divergence. Since the Brexit referendum, UK equities have underperformed their US and global peers. But interestingly, the FTSE 100, dominated by global multinationals, Shell, BP, Unilever, AstraZeneca, has held up better than small and mid-cap domestic companies. Why? Because the big players earn in dollars, euros, and yuan, not just pounds. Value tilt. The UK market is heavily value-weighted: energy, financials, materials, consumer staples. That's fine when inflation and commodities are high, but it struggles when tech and growth dominate global capital flows. Discounted valuations. Here's the bright side: the UK market trades at a deep discount. The forward P/E on FTSE 100 companies sits around 10x 11x versus the S&P 500 at 20x. For income-focused investors, dividend yields north of 4% to 4.5% are common. Investor sentiment, but sentiment remains low. Over £100 billion has flowed out of UK equity funds since the Brexit vote. That's an incredible number. If you're investing today, that pessimism can either scare you or make you curious. Graham Stephan style? It's the classic everyone's running from the fire, that's when I start walking toward it, carefully. There are contrarian opportunities in UK stocks precisely because everyone's given up on them. Example? Funds like Vanguard FTSE 100 UCITS ETF, VUC, or iShares MSCI United Kingdom ETF, EWU, give low-cost exposure. For active plays, look at fund managers like Linsell Train, known for their Quality Growth UK tilt. And if you're using brokerages like Interactive Investor, Free Trade, or Trading 212, you can easily access these funds commission-free. Just make sure your portfolio's diversified beyond domestic holdings. 2. UK property market. The UK property sector has long been a magnet for both domestic and foreign investors, but the post-Brexit and post-rate hike environment completely changed the calculus. Interest rates bite. Mortgage rates in 2025 hover around 5.5% to 6%, which has cooled housing demand and dragged down average prices. Nationwide reports tilt a 2% nominal decline year-on-year, and London prime properties are off 5 to 8%. Buy-to-let squeeze. Landlords face tighter regulations, higher taxation, and reduced mortgage interest deductions. Yields have compressed while maintenance costs have surged. Commercial property stress. Office vacancies in central London remain elevated post-pandemic, though logistics and industrial properties, particularly near ports and e-commerce hubs, remain resilient. Foreign investment shifts. Sterling weakness once made UK property a bargain for overseas buyers, but political uncertainty and high borrowing costs have kept many out. Still, the market hasn't collapsed. Institutional investors, especially those hunting long-term income, like pension funds, are pivoting into build-to-rent, student housing, and green retrofit projects, areas supported by government and ESG-aligned mandates. If you're looking for exposure without being a landlord, real estate investment trusts, REITs, like British Land, BLND, Segro, SGRO, and Unite Students, UTG, are options. They've been beaten down but could rebound as yields stabilize. 3. Bonds and fixed income. For years, UK government bonds, gilts, offered negligible yields. Now, they're back in play. The 10-year gilt yield sits around 4.2% in late 2025. That's attractive compared to negative or near-zero rates just a few years ago. Inflation-linked gilts, index-linked bonds, are appealing if you think inflation remains sticky. Corporate bonds, especially investment grade, are yielding between 5% and 6%, offering reasonable real returns. The big risk? Fiscal policy. The UK's public debt ratio has ballooned past 100% of GDP, and rating agencies keep flashing warnings. Any misstep in fiscal management could widen spreads fast. But for cautious investors, laddering gilts through ETFs like iShares UK Gilts, IGLT, or Vanguard UK Government Bond Index Fund could make sense as a stabilizer. 4. Private equity, venture capital, and startups. One underappreciated area, UK's startup ecosystem. Despite Brexit's early chill, London remains one of Europe's top tech hubs. Fintech, health tech, and AI startups are booming again, albeit with different funding sources. The loss of the European Investment Fund, EIF, initially hurt UK VC funding. But new domestic initiatives, like the British Business Bank's Future Fund, Breakthrough, helped plug the gap. UK-EU.S capital ties are strengthening, with funds like Andreessen Horowitz, SoftBank, and Atomico still backing British startups. Valuations are down from 2021 highs, meaning better entry points for long-term investors. Platforms like Cedars and Crowdcube still allow retail participation, though you should treat them as high-risk plays. If you're a higher net worth investor, look into EIS, Enterprise Investment Scheme, or VCTs, Venture Capital Trusts. Tax-advantaged ways to invest in UK startups. 5. Foreign direct investment, FDI. This one's tricky. FDI inflows to the UK dropped significantly post-2016 and haven't fully recovered. Brexit-related uncertainty and global competition, especially from the US Inflation Reduction Act, have diverted capital elsewhere. However, sectors like renewable energy, life sciences, and advanced manufacturing are seeing new commitments. Recent trade deals with India and the GCC could attract regional capital. London's financial services infrastructure remains world-class. It's still Europe's top destination for cross-border finance. Section 4I Sector Deep Dive, Winners and Losers in 2025. Let's break it down by sector. This is where things get interesting, because even in a slow growth environment, certain industries thrive. 1. Financial services. Winners. Despite initial fears, London remains a global finance hub. Yes, some trading volume shifted to Amsterdam and Frankfurt, but the city adapted fast. The UK's lighter touch regulation post-Brexit gives it flexibility to innovate, especially in fintech and digital banking. Fintech unicorns like Revolut, Monzo, and Starling Bank continue to expand internationally. London remains a hotspot for private wealth management, though high net worth outflows are a concern. Losers. Traditional banking margins are under pressure from rising funding costs and increased competition from online banks and payment platforms. Investor angle. Exposure via ETFs like iShares MSCI Europe Financials, EUFN, or specific UK-listed firms like Barclays, Lloyds, or HSBC can be interesting for dividend yields. But expect volatility. 2. Technology and AI. The UK wants to brand itself as the AI capital of Europe. And there's truth behind the slogan. The government's AI Research and Innovation Strategy 2025 earmarks billions for compute infrastructure, data hubs, and upskilling. London, Cambridge, and Edinburgh have become major AI ecosystems, hosting startups in biotech AI, legal tech, and autonomous systems. Publicly listed beneficiaries, Darktrace, Oxford Nanopore, and ARM Holdings, relisted on Nasdaq, but UK-based. Still, the risk is talent. If visa barriers remain high, the UK could lose its competitive edge. For retail investors, consider thematic ETFs like Global X Artificial Intelligence and Technology ETF or HNF Artificial Intelligence UCITS ETF AITF, which include UK names in their global mix. 3. Energy and renewables. Massive opportunity here. Offshore wind capacity continues to expand. The UK remains Europe's leader. Projects like Hornsea 3 and Dogger Bank Wind Farm are setting global records. The government's 2030 clean energy targets are driving billions in infrastructure investment. Hydrogen and carbon capture pilot projects are attracting early-stage funding. Big names, BP and Shell, are pivoting hard toward green assets, while pure plays like SSE and National Grid benefit from electrification spending. If you're ESG-focused, funds like Legal and General Clean Energy UCITS ETF provide diversified exposure. 4. Manufacturing and exports. This is one of Brexit's biggest losers. Supply chain friction and rules of origin requirements make exporting to the EU costlier. Automotive and aerospace sectors, think Jaguar Land Rover, Rolls-Royce, have been hit hardest. However, trade deals with Australia, New Zealand, and India are slowly opening new markets. The UK manufacturing PMI in 2025 remains below 50, contraction zone, signaling weakness. Long-term, reshoring could bring opportunities, but it's still early. 5. Real estate and construction. Mixed bag. Residential construction has slowed due to high borrowing costs and planning constraints. Commercial property, particularly logistics and data centers, remains resilient. ESG retrofitting, energy-efficient upgrades, is a growing subsector. If you're bullish on the property rebound, Segro, SGRO, and Tritax Big Box, BBOX, are worth watching. 6. Consumer and retail. Consumer sentiment in 2025 is fragile. Inflation and high mortgage costs squeeze disposable income, but there's resilience in premium and online segments. UK e-commerce firms like ASOS, Boohoo, and Ocado are still navigating profitability issues, while grocery giants Tesco and Sainsbury's benefit from their scale. For exposure, you can look at SPDR MSCI Europe Consumer Discretionary ETF, though I'd tread carefully. UK consumer confidence remains below its long-term average. 7. Healthcare and life sciences. A quiet outperformer. Post-pandemic investment in biotech and pharma remains strong. The Oxford-Cambridge corridor continues to attract global capital. UK-listed firms like AstraZeneca, GSK, and Hikma anchor the sector. This area benefits from both domestic R&D spending and global demand. For long-term stability, it's one of the most promising UK sectors. Before we move into the risk section, quick reminder. If you're serious about investing and want to stay ahead of global shifts like these, use tools like Morningstar UK, Simply Wall ST, or TradingView to screen for undervalued UK equities. I'll leave my favorite analysis tools linked in the description below, some even offer free trials or discounted plans. And if you find value in this breakdown so far, hit that like button. It really helps the video reach more investors who might be wondering what the UK's investment future actually looks like.